Welcome to this week's edition of Reverse Mortgage Weekly, where we hop on every single week and do a quick overview of the reverse mortgage program, this wonderful program that's changing people's lives every single day. So let's hop right into it here. My name is Zach Smith. I'll be your host today. And if you want to learn more information or you want to schedule appointments with us or anything like that, you can always reach out to us at chariotreverse.com. So, again, I'm your host. I've been in the industry since 2003, so that's about 20. It'll be 21 years in May, actually, that I've been in the mortgage and real estate business. I've also been a five-star professional here locally since 2018. I'm a certified senior advisor, and I am a wholesale mortgage broker, which most folks who will offer the reverse mortgage product are usually brokering these loans out. I don't know of any. There are some retail banks out there, but most people are brokering these out. And we prefer to be brokers because then we get to pick and choose who we can send our clients to. We have great relationships with Mutual of Omaha, AAG, Longbridge, SmartFi. So there's a lot of different options that we have in regards to sending clients for the reverse mortgage program. So, who qualifies for a reverse mortgage? Well, you must be 62 and better or better. In some cases, we can do loans with 55 and up. Those have become a little less common with the interest rate environment that we're in. It must be your primary residence, so you have to be there at least 6 months in a day. So, I've had clients that have, used the reverse mortgage to purchase, vacation homes. So they take money out of their primary residence and then put that into a property that they're going to be vacationing at. Well, they want to be snowbirds. So, as long as they're in their house 6 months in a day, that's really the key for the reverse mortgage is that it has to be your primary residence. FHA programs are available. There's somewhat, again, we do have some conventional programs that we can work with, but they're just not as common. And quite frankly, the terms aren't as great either. So by and large, the FHA program is the program that we see being originated right now. You do need equity or a large down payment, and all that's going to be determined by your age. The risk assessment for a reverse mortgage is much different than what you'll see with like conventional financing. If you're going in to purchase property and you just want a plain vanilla 30-year fixed loan, basically they're going to be looking at your income, your assets, and your credit is going to be how they determine the risk. As you, a borrower, with the reverse mortgage, because the payments are optional, well, how do you determine risk? Well, it's really based on your age and the equity position that you're in. And there are minimal income qualifications. It's much like a VA loan in the sense that we're doing basically looking for residual income calculations, just making sure that you can afford your taxes, your insurance, your HOA, maintenance on the property, and that's done by a calculation of the square footage. So very minimal income qualifications. That's why people really like it, especially retirees, because retirees are not in a position where they're making a lot of income like they used to. Reverse mortgage information, again, FHA administers the home equity conversion mortgage. You may hear the term HECM. Well, HECM is basically just FHA's term for a reverse mortgage. Real fancy name for a reverse mortgage. According to the U.S. Department of Housing and Urban Development, more than 500,000 households across the nation have a HECM reverse mortgage. That stat has actually grown quite a bit. This is from a few years ago. Again, they determine the amount that people can borrow by the age of the youngest homeowner, current interest rates, and the value of the home, basically their equity position. And many of these are adjustable rate mortgages, which, people hear that, oh my gosh, you don't want to be in an adjustable rate. That's pretty bad deal, Well, the thing is that if you're in a forward mortgage, yeah, it is a bad deal because if the rates go up, you're going to end up paying out of pocket more. Although we, meaning my household, we actually refinanced into a adjustable rate mortgage not too long ago. We're in a simple interest loan where the misnomer about interest rate is that lower rate does not necessarily mean lower payment. I won't go into too much detail about that, but really being in an amortization schedule is really puts you in a position where you're stacked, that the deck is stacked against you, meaning a 30-year fixed or even a 15-year fixed. It sometimes it's much better to do a 15-year fixed, but your payment doubles. So it's something that you may or may not work out for your household. But I won't get into too much of that. But the thing about the reverse mortgage, though, is that with it being an adjustable rate, a lot of people look at that and they'll say, well, that's a bad idea. But it's a bad idea if you have to come out of pocket for your payment. Well, with the reverse mortgage, you certainly can come out of pocket for a payment if you'd like, but it's optional. So if you want to make a payment, you can. If you don't want to make a payment, then you just let it go on to the balance of the loan. And that's one of the things that, I had a conversation with somebody just the other day that said, oh, guy, I don't like those reverse mortgages. My one of my friends sold her parents' house and she only got $7,000. And she's thinking, well, that's a bad deal. The balance grew and she only got $7,000 from the sale. Well, then next question I asked that, really took her off guard was, well, how many payments did they skip? Oh, well, they've had it for 20 years. Well, yeah, that's 240 payments that they did not have to come out of pocket with. And if you do the math on that, that's like $280,000 that they would have had to come out of pocket. And the big issue right now are the kids having to come out of pocket. There's this small publication, Forbes, that came out with an article just a few years ago that talked about how people's parents could be their largest financial risk. And it's so true with the cost of long term care, the cost of aging. Parents can really just start to snowball. In fact, we've had clients that have come to us before in the past. I remember this client in particular. Her father, his mortgage payment was about $1,500 per month. Well, he made about $1,800 per month on Social Security. He had no other sources of income. So she was having to supplement her income every single month just so her father could make it every month. Well, that's a recipe for disaster. So we got a call from her saying, "Look, I can't do this anymore. This is really crushing me. I know I want my father to be taken care of. He wants to stay in his house. We want to retain ownership, but I can't continue to supplement my income so that my father can pay his mortgage payment." And keep in mind, when you're paying mortgage payments on an amortized schedule, I mean, a good portion of that is going right to paying the interest, not paying the loan off. You're taking your hard earned retirement, you're taking your hard earned income, you're taking your life savings, and you're giving it right to the bank in interest in a 30-year term. So, so what we did was we were able to convert his current mortgage into a payment optional program. So we basically transferred about $1,200 per month into a payment optional program, which means that he doesn't have to make that monthly payment if he doesn't want to. Now he can, and that's a real big misnomer about the reverse mortgage. I started to go into the story about the folks who said, "Oh, we only got 7,000." Well, they skipped 20 years of payments. So, that 280,000, I mean, you either take it during the time when they're making those payments, that's when you're basically setting that up, or you take it at the end. The reverse mortgage works great for people because then the bank allows you to pay off that loan at the end, not during the course of that time. So by eliminating $1,200 from this gentleman's payment, now instead of him having to come out of pocket $1,500 for his housing expense, he was only coming out about $300. Well, now the daughter doesn't have to supplement her income. He still gets to retain ownership of his home, and he's able to make it now on his Social Security. So, this program, I've seen it time and time again change people's lives overnight. And people always ask me, well, what's your opinion of the reverse mortgage? Well, I'm the wrong person to ask, to be frank. I mean, I'm drinking the Kool-Aid. I'm here promoting the product because I've seen what it does for people's lives. The second I turn eligible for a reverse mortgage, I'm running down to the bank to get one because I know the financial planning aspects of this and the long-term growth strategies that are incorporated with this program. So I know it. I've seen it happen. I know all the data. I'm the wrong person to ask because I'm going to tell you, go do it. But if you really, truly want to know how this program works and how it's working out for folks, talk to somebody who has one. Don't talk to your uncle down the street who says it's a bad idea. Don't talk to, the people who don't know anything about the program. Talk to someone who has one and see how it's working out for them. So, this is so benefits of a reverse mortgage. Again, you still get to keep title to your home. That's a misnomer. A lot of people think that you give up title to the bank. Couldn't be further from the truth. Again, basic credit, income qualifications, basically tax-free cash from equity in your home, meaning that if you choose what they call a tenured payment, you can get paid back from the equity in your home each month, and you're not taxed on that because it is considered a loan. Same thing with qualifying for Medicaid and things of that nature. Even though you're receiving a check each month from the mortgage company, it's not considered income. So, Medicaid really monitors your income for qualifying purposes. Well, it's not considered income, and you shouldn't be disqualified for Medicaid because you're receiving income with a reverse mortgage. In fact, a lot of home health care companies utilize this program so that their clients can afford the services they desperately need. So here are the two biggest myths that I run into is that one, you lose title to your home. Again, couldn't be further from the truth. And two, that you're upside down on the property the minute you take one out. That's like, calling the farmer up and say, oh, you planted your crop yesterday. Where's your yield? Where's your crop at? Well, I just planted it yesterday. The thing about the reverse mortgage is that yes, you can go upside down, but it takes a very, very long time to do that. It's been my experience that most people would have to live till about 150 to go upside down. And of course, that's going to depend on market conditions and interest rates and things like that. If meteor could hit the earth tomorrow and all bets are off, but based on current market conditions, that's basically what we're seeing. So it's tough to talk about this program without talking about retirement in America. I'm not going to spend a whole lot of time on this, but generally, this is what people have. They have three buckets pre-retirement. They have their income, your red bucket here. You're making income, and then you're taking that income and you're putting it into a 401k, into your nest egg, savings, and then you're also paying off your home equity, paying down your mortgage. Well, the state of affairs is pretty bleak right now when it comes to retirement. If you don't believe me, go find yourself a financial planner. They will talk your ear off about this stuff. You know why? Because it's a serious issue that a lot of people just have not planned for over the years. And this is basically just a graph showing that how little people are saving right now. So again, we get back to our buckets. Pre-retirement, you have your income. You put that into the yellow bucket as savings, and you're also paying down the home equity in the green bucket there. Well, post-retirement, these buckets change completely. The first change that we're going to see is the red bucket. The red bucket shrinks. A lot of times people have limited income in retirement. They're not working as much. They're working part-time. They have fixed incomes like Social Security, annuities, things of that nature. So they're not making nearly as much as they did when they were working in their younger years. The second change that we see is that we have a throne here for the yellow bucket. I mean, I wonder why we have a throne there. Well, that yellow bucket becomes vitally important. In fact, it's the number one fear that most of my clients have that work with the reverse mortgage is running out of cash prematurely. Again, people are saving for retirements right now, but those that are saving are really not saving enough. So you could live to 70, you could live to 80, you could live to 90, you could live to 100. Well, the difference between 70 and 100 is 30 years. So to have that bucket be as solvent as possible is really the goal that I have for every single one of my clients. If it were up to me, none of my clients would ever have to touch their nest egg. They would be bequeathing that onto their heirs. But that bucket becomes vitally important because we need it to survive. And then you have your home equity, which is usually abundant and idle. I can't begin to tell you how many people that we work with and that are just across the nation that are equity rich and cash poor. The good thing about having equity is it's there, but it's a lot like having a glass coffee table full of cash right there in the middle of your living room that you can't get to. So, it's you have a glass coffee table there. It's not like we can take a picture of our house and go down to the grocery store and pay for our groceries with it. Equity is great to have, but the downside to equity is it's not liquid. And in retirement, people need access to liquid assets to survive off of, unless this first bucket is overwhelmingly large. And some people have a great retirement. A lot of people have pensions. They have, a large Social Security payment. Those things are great, and I have several clients that are in that position, but not a lot of Americans are. They have not saved enough. They're dwindling in cash, and they're not making enough on a monthly basis to really make it each month. So basically, pre-retirement and post-retirement buckets, these buckets change quite a bit in retirement, which makes your life savings very important, as well as your home equity, as to be used as a tool. So again, home equity is there's trillions of home equity right now across the nation. There's been a large spike in housing, and there's a lot of studies going on right now about the housing market, and I have clients that are waiting for the crash, like we had in 2008. I've got news for you. It's not coming. The crash is not coming in the housing market. There is an overwhelming demand for housing right now. Freddie Mac expects that there's going to be 50 million millennials that enter the housing market in the next 10 years. The millennials have not gotten very good advice. They've gotten the advice of rent. Oh, you don't want to own, rent. And you know who's behind a lot of that advice? Our friends at the hedge fund companies, BlackRock, and a lot of these corporations. And if you'd like to dig in or go down the rabbit hole, so to speak, on this subject, go ahead and Google corporate landlord and see which articles come out, because there are huge corporations that are buying swaths of properties in the suburban areas because they want to keep people as lifetime renters. As a business model, it's great because everybody needs house to pay for a house. Housing is the least debt that is going to go late. People will not pay their energy bill, they won't pay their gas bill, they won't pay their credit cards, their car payment, but generally they will pay for housing because they need a place to stay. It's a very stable source of income for a lot of these corporations, and if they can turn somebody into a lifetime renter and collect all the equity over time, oh my gosh, that's a great deal for them. For the people, it's not a good deal at all. So again, what is equity? Equity is great to have, but again, it's a lot like having a glass coffee table right in the middle of your living room full of cash. It's a lot like having, stacks of Monopoly money. Yeah, you got it. It's there, but if you try to, pay for your gas, or something goes wrong with the car or something, it doesn't do you any good at that point because you can't get to it. So accessing that equity in retirement becomes vitally important, and that's the number one reason why people choose the reverse mortgage. It's because that glass coffee table that's in their living room full of cash. Well, the reverse mortgage basically just installs a drawer so that you can take the cash out when you need it. When you don't need it, you don't have to take the cash out. That's a huge, huge misnomer about the reverse mortgage, is that you go upside down or you have to go into a negatively amortized situation. No, no, no. You can treat this just like any other loan. If you want to pay the loan off in 10 years, pay it off in 10 years with monthly payments. If you want to pay it off in 30 years, pay it off in 30 years. Now, 99% of my clients choose not to do that because it's not required that you make a monthly payment. The monthly payment can be paid at the end when you vacate the residence, either by passing, going into a facility, or it's no longer your primary residence for some reason or another. So, based on that information, people are choosing not to make their monthly payment on a reverse mortgage, but doesn't mean they can't. You can still make a monthly payment. You can still pay it off. That's a big, big misconception that I really want to drive home with this program because people think that, oh, you're just locked into a negative amortization. What a bad deal. Well, it's just like the example we talked about earlier. The folks who only got $7,000 at closing, well, they didn't have to pay 288,000 as well, though. So it's like, what do you want? Do you want to pay that 288,000 over the course of 20 years and get the equity at the end, knowing that a lot of that 288,000 that you're paying in monthly payments is going right to the bank and interest anyways? Or would you rather have a higher quality of life for 20 years, not having to pay that interest to the bank out of pocket? And then at the end, when you no longer need the house, when you're selling the house, and that was a situation, her parents had passed. And at that time, then that over that course of 20 years, they didn't have to struggle in regards to making a monthly payment. They had a secure place to live over the past 20 years. But there's this sentiment that, oh, it's a bad idea. Oh, it's a bad. What I think is a bad idea is to struggle every single day taking money from your life savings to pay a mortgage payment. That's what I think is a bad idea. There's no reason why people should do that because the thing is that again, you do not want to touch your life savings. And I have several clients that we've worked with that were touching their life savings so that they could pay a mortgage payment. Basically, take their life savings and hand over a majority of that payment goes directly to the bank in interest. Again, on a 30-year fixed loan, you pay 50% of the interest in the first 10 years. That's a great deal for the bank. Great deal because you're barely paying the loan off, but they're getting a boatload of interest. So the whole sentiment that it's better to struggle for 20 years and have a lower quality of life and then cash out at the end. I guess that's a strategy you could take, but over the course of 20 years in this example, the parents weren't struggling. They had enough cash flow to make it. They're able to age in place, which basically, all the studies show that you live longer, you have a better sense of community. Things are much better for people when they're able to age in place. So that's really the philosophy. And when you really look at things, and the issue that I have found, and that many people have found that are educators, is the way people are brought up and the way people think. People think that a 30-year fix is a good deal. It's not a good deal. It's a good deal for the bank. And, the other part of it is, well, what's the alternative? Well, you could do what we did, and you could refinance into a simple interest loan where you're paying directly to principal. I have a large deposit that goes into my account. Well, guess what? My mortgage payment goes down the next day. So, I don't know that enough people are really educated enough financially, especially when it comes to mortgage lending, to to see the benefits. And that's why we're here, is to shed light on the subject. So, why are people taking these out? What are the benefits? Well, number one is increased cash flow. The optional payment creates a situation where you automatically give yourself a raise overnight. Asset protection. A lot of people look at this program and say, oh, that's a program of last resort. You do that because you ran out of money or you're poor or something like that. No, I have several clients that have millions in the bank. They have their home paid off free and clear, and they still will do a reverse mortgage for the line of credit. The idea is, one of the questions I ask all of my students, and I teach for the state here in Colorado, is that, if I had $1 million cash or a penny that doubles every day for 31 days, which one would you want? Well, you want the penny. I mean, $1 million cash sounds good, but if you take a penny and you double it for 31 days, guess how much it's worth at the end? $10 million. If you double a penny for 31 days, one penny, two penny, four penny, eight penny, 16 penny, 32, so forth, you will find that that penny is worth about $10 million after 31 days. Well, what's it worth at 15? It's worth about 115 bucks at 15 days. Same thing with our retirement accounts. Because the equity is not liquid, a lot of times when people run into financial trouble in retirement, whether it be health reasons, medical bills, just spending, things like that, things come up. There's one constant in life, and that's change. Well, if they reach into their nest egg, they're taking that penny out at 15 days. You want to keep your retirement accounts in that vehicle, whatever vehicle they're in. You want to keep them in that vehicle long term. You don't want to touch them. Well, if you can access your equity instead of reaching into your nest egg, well, guess what? Now you create a situation where you may not be passing on to your heirs, or you may not be accumulating as much equity as you were before, but guess what? Your net worth is going to go up exponentially. And there's basically a lot of studies that have shown this as well. And we'll go into a little bit of that here in just a moment. If we have time, we keep these at 30 minutes. I'm always happy to have a personal consultation. So, third reason is it's a non-recourse loan. That means you're never going to owe more on the property than what it's worth, and it doesn't require repayment until the last living resident that's on the loan passes, or it's no longer their permanent residence. This is the most friendly program that you can have when it comes to people passing away, because they will give the heirs 6 months to determine what to do with the property, plus an additional 2 free 3-month extensions, but you do have to ask for those. You have to petition for those. So you potentially could have an entire year where they're going to give you to sell the property, get your affairs in order, if someone does happen to pass. That doesn't happen on a forward mortgage. If people pass on a forward mortgage, they want their payment. You got to crack that nut every single month so that you can pay the bank. The bank wants their payment. If you miss 3, they can start the foreclosure process, and they can sell the house out from under people. So the reverse mortgage is an extremely friendly program when it comes to that. And it's a great way to purchase property as well. A lot of people they don't want a mortgage payment after they're 62, and you shouldn't be paying a mortgage payment after you're 62. Because if you are, you're either taking it from bucket 1, which is usually not as large, it's a cash flow issue, or you're taking it from bucket 2, which is your crown jewel, the bucket you don't want to take from. It's in a throne, and you want to keep your nest egg solvent over the years. So let's say you have a $400,000 property, and you don't want a mortgage payment, so you pay $400,000 cash. I think I would never do it. And the reason I would never do it is because I know that once I put that $400,000 into the transaction, well, guess what? Now I don't get to see that $400,000. It's locked up. I basically handed $400,000 over to a buyer. Here you go, Mr. Buyer. Or I hand it over to a bank. Here you go, Mr. Bank. And what do I mean by that? Well, if you want to get that $400,000 back out, you either got to sell the property, which begs the question, if you sell your property, where are you going to go? Or you put it in the hands of a bank. Well, you have to call someone like me, a lender that says, hey, we'll get you a portion of that $400,000 back out. Well, what a lot of folks say is, well, why don't we use a reverse mortgage for $200,000, and then we'll put down another $200,000. So now you have $200,000 that you have cash sitting on the side. Well, what if you put that into an investment? What if you put that into life insurance policies for your grandkids, which are very, very low rates, but you get the same amount of growth on them at the same time as a vehicle to also borrow against? You become your own bank. There's a lot of different ways that people can utilize this cash, but if you put it all in the property, you don't have that option anymore. So, how can older adults unlock equity with a reverse mortgage? Well, you can choose a lump sum. So, guy shows up with a suitcase full of cash, handcuffed to handcuffed to his wrist, and just hand you a suitcase full of cash. You could also do a line of credit, which is, the beauty of that is that it's got guaranteed growth on it. So it's almost like having another savings account. And the growth is tied to current rates. Well, where are rates right now? Rates are pretty darn high. Well, that's not necessarily a bad thing if you got a reverse mortgage line of credit, because that means that your growth rate on your line of credit is growing at a higher clip. And then also monthly loan proceed payments. It's called a tenured payment. We can, people will do that for 5, 10, 15, 6, 7, 8, whatever term you want, we can get it set up for them. Well, that's all we have for you today, folks. We try to keep these at a half hour every single Thursday. So I hope you got something out of this. And if there's any questions that you have for me, you can always reach me at chariotreverse.com. Thanks a lot for hanging out with me today. And I hope you have a wonderful rest of your day. Thanks a lot.